Stanley Druckenmiller, buy low, sell high, is selling tech and buying mining shares. Oh, wow, that's revolutionary. And right now, they're telling you it should at least be almost $3 higher than the make-believe Western price, and we all know that's even way too cheap. If they were smart, they'd crank it up even higher, but is that smart? That's what you just explained is asymmetrical risk reward, is what can I invest in that has the lowest downside and the best upside? I mean, I don't know if I've ever seen an asset quite like silver, which is decreasing in supply globally in terms of mining supply, what's in the ground, the gold-silver ratio, mining ratio, and as an acceleration in demand, something people should stop worrying about in terms of today and tomorrow and just realize logically, mathematically, it's pretty damn sure, I'm pretty damn sure that we will wake up one day and see prices higher than people can really even imagine.
As anticipated, inflation figures dictated the trajectory of the gold market this week. The notable event was a significant drop in prices on Tuesday morning, triggered by unexpectedly high CPI data for January. Spot gold, which was per ounce minutes before the announcement, plummeted. Subsequently, prices mainly fluctuated within a narrow $12 range on either side of the $2,000 mark until a minor downturn occurred following Friday morning's PPI release. However, there was a swift but modest recovery followed by a gradual ascent leading into the Precedence Day-long weekend. Now we'll show you more clips of Andy Schectman and his insights on the precious metals markets. But first, subscribe and turn on notifications. Let's get into the video.
Where $2.50 or $2.75 premium to the Western price is being offered to those sophisticated enough to be able to buy it in London or New York and deliver it in China, they ain't ever coming back. And so this is a methodical process, this little by little by little, then all at once. I say it all the time, logarithmic decay. You can use it in so many facets of the world we find ourselves in right now, and this is no different. So they're playing chess, we're playing checkers, and we will wake up at a point in time, and silver will have moonshotted, and no one will know what the hell happened. But guys like you and I, who have been talking about this forever, will have a very good idea what had happened. And what it, to me, will ultimately transition is the COMEX and the LBMA will no longer be beholden to a Western rehypothecated of almost 1,800% system. It will transition to some place like Shanghai, which is largely cash and carry, a reflection of what the price should be. And right now, they're telling you it should at least be almost $3 higher than the make-believe Western price, and we all know that's even way too cheap. If they were smart, they'd crank it up even higher, but is that smart? That's cutting off your nose. Now everyone will grab and say, well, something's not right here. But if you do it just enough to incentivize these traders to arbitrage, it's really, I think, and you look at how much silver's coming off in gold and rare earths and base metals and all of this stuff coming off the exchanges, they'll continue to do this until no one is foolish enough to let it go at make-believe prices. And then they flip the switch, rather. And now you see a new price-setting mechanism for the rest of the world by a country and countries that have been the ones understanding it, accumulating it, and producing it for years. Stanley Druckenmiller, buy low, sell high, is selling tech and buying mining shares. Oh, wow, that's revolutionary. What you just explained is asymmetrical risk reward, is what can I invest in that has the lowest downside and the best upside? I mean, I don't know if I've ever seen an asset quite like silver, which is decreasing in supply globally in terms of mining supply, what's in the ground, the gold-silver ratio, mining ratio, and as an acceleration in demand, both militarily and industrially, green and digital, and monetarily. And this duality in demand, it's not just one demand source for a commodity, it's several, coupled with its diminishing supply and its suppression, where, several years of structural supply deficit issues in silver. And at the same time, you have a lot of the speculators in this market who are getting frustrated and capitulating. Some are. And so this big rise that everyone expected, that attracted them in the first place, if you believe in contrarian indicators, it's got to be getting imminently closer. And then you see all of the stuff draining off of COMEX and the LBMA and the Shanghai Gold Exchange. And yeah, I mean, to me, it's something people should stop worrying about in terms of today and tomorrow, and just realize logically, mathematically, it's pretty damn sure, I'm pretty damn sure that we will wake up one day and see prices higher than people can really even imagine.
For months, economists have warned about persistent inflation, which remained a challenge last week as both consumer and producer prices rose unexpectedly. Gold and silver prices dropped to multi-month lows, with investors favoring equities and Bitcoin over gold. Despite this, precious metals held critical support levels, with silver rebounding by 7%. Geopolitical uncertainties and record Valentine's Day spending on jewelry in the U.S. maintained demand for gold. China's dominance in the gold market continued, with record high activity in several sectors. Despite selling pressure, analysts still see opportunities in buying gold during deeps. Now, in the continuation of the episode, we'll show you more clips of Schectman. But first, hit the like button, smash the subscribe button, and turn on notifications. Let's get into the video.
Last year, we're not in the dollar. That's not something we're used to seeing. And so when you talk about settlement in all throughout, Russia and Iran are not taking dollars anymore. United Arab Emirates said they're not going to take dollars anymore. All of these countries are trading with one another. India and Saudi Arabia and Russia and China, and Iran, they're all trading in local currencies. And what the petrodollar is not just being valued in dollars. That's part of it. The other part is taking the proceeds, the reserves, the excess, and investing it in U.S. Treasuries. Well, the Treasury market, that's not what they're doing. They're selling Treasuries. And if you look at what gold has done since 2000, it's appreciated by 7.8% per year. That's more than the 7% appreciation per year on the S&P, and has destroyed the bond market. And gold, as we were saying with your silver, has no counterparty risk. So these countries who have been accumulating all the gold, the central banks buying more than ever, at the same time, they're shedding treasuries. China's down to like their lowest level in 17, 18 years, as are most of the BRICS countries, as are a lot of the central banks around the world. They're shedding treasuries and buying gold, which has much less risk in terms of, interest rate risk and inflation risk and default risk. It has no counterparty liability, and it's way outperformed the bond market. So when you talk about all this settlement not being done in dollars and much less demand for U.S. Treasuries at a period of time where we have a government addicted to spending, where's it all going to come from? How about the $8 trillion just in 2-year Treasuries that are rolling over this year that need to be paid for? How about the almost $10 trillion in debt we have to issue this year just to pay for what we've already promised, on top of the $1.7 trillion deficit, on top of a government says they're going to lower rates? No. They're not, because who's going to buy those bonds? It makes it that much less attractive. You have to borrow more just to pay for what you already borrowed. It is a very, very, very bad situation. So the bond market, which is cratering, you could argue the worst performance in, 45 years, where the 10-year Treasury had greater volatility than the gold market for the first time in 45 years. You have these central banks trading with other currencies, not the dollar, for energy or for whatever it may be, and then taking the reserves that they have and buying gold with it. Just like on the Shanghai Gold Exchange, you can trade with China. If you're Iran, sell your oil to China for the yuan, and which is immediately convertible into gold on the Shanghai Gold Exchange. And they are using gold, in my opinion, as their reserve. So all of the settlement not done in dollars chips away at the reserve status of the dollar. And now you see less interest in the U.S. Treasury market, which, Ron, think about it. In a historical perspective, a government's debt has a very small footprint in terms of historical significance of being an asset. Well, for a long time now, the last 50 years, the U.S. Treasury has been the most liquid, sought-after asset. But those things are changing. And now these governments are, I think, finding the performance and the safety and the lack of counterparty liability more preferential than holding U.S. Treasuries.
What do you think of today's episode? Do you agree with Andy Schectman? Do you feel secure with your savings in dollars? Post in the comment section down below your insights on the video, especially if you'd feel safer having crypto than money in your bank account. Thanks for watching it to the end. Take advantage of the massive sign-up bonuses to get crypto. If you have not yet done so, subscribe to the channel and check this upcoming video because you'll love it. I see you on the other side.